of years, what we've seen in the region is fair degree of diversity in economic outcomes. The countries that are driving this recovery are the oil exporters, but they are also the ones that dragged growth down in 2015-16 in the region. So they're displaying a muted recovery this year and next year. But I also want to flag that there continues to be quite a lot of countries that have been enjoying fairly robust growth. So we have about 22 countries that have been growing around 6% in the last several years. In some, we have a picture where growth in the region is going to be recovering from 2.7 to 3.1 next year and accelerating further to around 3.8. Largely driven by the oil exporting countries recovering back to their pre-crisis levels.
Now, cross-border capital flows in Sub-Saharan Africa did, from rather official sources, have increased sharply since the global financial crisis. And this is quite surprising revelation, that net capital flows to Sub-Saharan Africa were higher than those to emerging markets. And that was just in the most recent years. Talk to us more about this.
So, overall, what we've seen in Sub-Saharan Africa over the last 20-odd years is about increasing integration into global financial and capital markets. But one of the striking findings is indeed that in the period of 2015-17, that 3-year period, when you look at it as a ratio to GDP, capital flows to the region has been actually quite very significant and markedly more than in other emerging market countries. This is, an insight which we don't often internalize when we're thinking and talking about Sub-Saharan Africa countries. By the same token, reliance on such capital flows is a double-edged sword. In particular, it requires very careful economic and financial management, as some parts of these flows, the portfolio flows in particular, are subject to quite a bit of volatility. And we see this at the moment, where we've seen, in the wake of the continued increase in the Fed's interest rates, also uncertainty in some emerging market countries. We've, of course, seen pressure on borrowing costs for the region returning, and also some pressure on exchange rates. So it's a double-edged sword. This inflows can help facilitate more spending by the government, by the private sector, but it's something you don't want to rely on excessively.
All right. Doctor, we do know that, of course, the RIO looks and examines the role of the fourth industrial revolution and how it will impact Africa's nature of work with countries in the region. But how practical are the ideas around the fourth industrial revolution with computer penetration and internet penetration on the continent particularly low, with only 40%, under 40% actually?
Okay, so I think, it's something that policymakers cannot completely ignore. There's a couple of reasons for this. I mean, first is, the so-called fourth industrial revolution entails quite a lot of technologies, but some of them are technologies that could possibly replace low-end manufacturing type jobs with automation. And of course, there is quite a lot of desire and targeting of low-end manufacturing jobs to come to Sub-Saharan Africa. So to the extent that these very jobs are being endangered by automation, that could be a challenge that the region faces. So, the fourth industrial revolution is something that we cannot ignore. So what our study shows is that, the region needs to create of the order of 20 million jobs per year, within 8 to 10 years. At the moment, we only create around 10 million jobs. So there's a big need to increase growth to be able to, job creation, labor intensity of growth in the coming years. And, we also see at the same time, the need to invest in ways in which the region can be more competitive for the jobs of the future. So, boosting our education systems, boosting our internet infrastructure are all going to be part of the answer to this.
All right, now allow us to move on to the next conversation. Of course, financial sector vulnerability in the region and some countries are with very high non-performing loans, and we're looking at low bank profitability and significant shortfalls in the capital ratios. While in other countries, attractive returns on government securities have supported banks with profitability on the same. Now, tell me, give us a little bit more on this. Of course, we've seen East Africa suffering the same.
So one of the things that we flag is the rising level of non-performing loans, as you noted. This has to do with a range of factors. First of all, there is a concentration in the increase in non-performing loans in the region in the very countries that have been hit by the decline in commodity prices. But elsewhere too, what we've seen is as governments have been unable to service, to pay on time creditors, for example, and running arrears, we've seen those companies running arrears being unable to service their loans to the banking sector. And overall, even in the countries that have continued to grow rapidly, we've seen an increase in non-performing loan levels. Part of the solution to this has to do with reducing the extent of crowding out by the public sector, so reducing fiscal deficits, relying more on tax revenue mobilization and less on borrowing will be an important contributor to this. But part also has to do with the need for central banks and other supervisory agencies looking to ensure that the banking sector increases capital levels and has robust ways of coping with rising non-performing loans.